Welcome back to Power Lunch. Remember last week we told you about the return of the 3% down mortgage? Now wait until you hear about this loan being offered. Diana Olick's got that story from Washington. Diana.
Well, Melissa, remember stated income loans? You could just tell the bank where you worked and what you made. They called them low doc or no doc loans during the housing boom. And then after the housing crash, they called them liar loans. Well, one community bank in Queens, New York, Quantic, has just introduced the Lite Doc loan program. And what do you get to need it? Well, what you need to get it, different than the old loans. For one thing, you need a really big down payment, 40%. You have to have a minimum 700 FICO credit score, and you have to occupy the home. But all you need on the document side is verification of employment, 2 months of bank statements, and enough cash in a checking account at Quantic to cover all the costs of the loan for 6 months. Now, for those of you who know today's tight mortgage rules, you know this does not comply with new federal regulations called the, quote, ability to repay rule. So how's this legal? Well, Quantic is designated as a CDFI, that is Community Development Financial Institution. It's part of a Treasury program from 1994 to help revitalize low-income areas. Now, that said, Quantic can make these loans to anyone, anywhere. So far, they're only doing it in New York and Miami. Now, I spoke with the bank CEO this morning. He said, quote, I see them as extraordinarily low-risk loans. They're mission-oriented. The worst-case scenario, he said, is that the borrower goes delinquent and you have to foreclose. Okay, well, there is, of course, nothing to keep these borrowers from lying on these loans, as has happened in the past, we know.
Diana, is this a profit-driven institution, or is this a nonprofit institution?
It's not a nonprofit. It's a community bank, which by virtue of it being that type of bank, is it's supposed to be giving back to the community, doing what it does within the neighborhoods to help revitalize those economies. And that's why it's part of that Treasury program, but it is not a nonprofit.
Got it. All right. Thanks, Diana. Let's bring in Bruce Marks. He's the CEO and the founder of the Neighborhood Assistance Corporation of America. This is a nonprofit that provides loans to low-income individuals who are considered to be subprime borrowers. Good to have you here, Bruce.
It is great to be on again. Thank you for having me.
What did you think of these low doc loans? You have to put down 40% for the down payment. That's a big whopper of a down payment.
Well, it is, but look, this is going back to the predatory lending, but it's even worse because it's taking what's supposed to be for low and moderate income people, and it's preying on using that to just make these mortgages that are really problematic. But most importantly, it's not going to help low and moderate income people. It's just it's the bottom dwellers who are there going to the depths of predatory lending again.
Why does it not help? Why does it not help these people, Bruce? I mean, if they can make the payments, if they've got that 40% down, they've got that very high FICO score, why can't these people decide on their own that this mortgage is for them? Why is it that they are being preyed upon?
Well, if you look back, look what recreated the mortgage crisis. It was people who had high credit scores, but they were able to put down anything on their mortgage statements and on their mortgage payments. And actually, what happened is that you have the lenders saying, if you want to get this mortgage, put down this income, put down how much you have in assets. But really, what built this country is full doc underwriting.
Is it different, though, this time? Because this is a 40% down that we're talking about. I mean, back in the crisis, we were talking about almost
no
nothing
money down, right?
Yeah, or no money down in some cases.
Yeah, but we've been doing the no money down mortgages for over 30 years. But it's always full doc underwriting. So when you do full doc underwriting, you're verifying your income, you're verifying your ability to pay. That's the key piece. So if they were so sure that this was the right thing to do, why are they using this,
because if you read, did you read the story that Diana wrote?
The ability to repay.
Did you read the story that Diana wrote? These are a lot of non-traditional buyers that don't have necessarily traditional incomes, a lot of immigrants who have to pool their resources. So to document would be incredibly difficult. They may have the money, but they don't have the ability to actually file the paperwork. So why shouldn't they be able to get this loan?
Because the paperwork that you have to require to do the ability to repay is not difficult. Is not difficult. So they shouldn't have to use the mechanism of a CDFI.
But they wouldn't qualify for a traditional loan, right? They wouldn't qualify.
But they do. But common sense says that if you're going to be in the lending business, anybody in the lending business, you should do the ability to repay. They shouldn't have to go through this CDFI, which is meant for low and moderate income people. But every form of lending, common sense says you have to document the ability to repay, and it's not difficult. It's very simple to do that. You just got to verify the income, verify the deposits, and that's what built the country. And remember, after World War II, what built the white suburbs? Because if you were a minority, you couldn't get those mortgages.
Okay.
It was a VA mortgage. It was a no down payment mortgage, but full doc underwriting. What caused the mortgage crisis was not the lack of down payment, it was the lack of documentation. And that means anybody who is listening to this says, you want to verify it. That's common sense,
Bruce,
the ability to repay.
thanks
They're just
so
trying
much.
a way to go.